Hey everybody, Alejandro here, rocking with you on a Friday, September 26th, 2025. A quick market update to let you know what's been going on in the world of mortgage. I'm sure there's been a lot of news recently, especially with the Fed rate cut that came. I do want to confirm that rates have gone slightly up since the Fed cut rates. As I mentioned before, the Fed doesn't control mortgage interest rates. They simply control rates for overnight lending for one day. Of course, although that might have an impact on the market, it has a minimal impact on mortgage interest rates. In fact, by the time the Fed cuts rates, most investors, most of the market has priced in that rate cut for the weeks, preceding that announcement, and that's basically precisely what happened. So what we're going to do is I'm going to show you a little bit of the graph to talk to you about what happened, so that you can see for yourself, and then I'll come back after and recap some of the things that we found out. Okay, here we go. Over the past couple months, 3 months or so, we've seen an improvement. You can see that this was back in July. We've seen a steady improvement, a little bit of bouncing, but for the most part, rates have been improving. But up until September, mid-September, this is around when the Fed cut rates. Everything kind of turned around and rates started going back up. This is the value of mortgage bond securities going down, which then correlates with interest rates going up. So this little reverse peak here, this downward trend, is not good for us, but we don't know where it's going to head. You can see this happens in other situations. If we zoom out for the past 6 months, you can see this improving and then getting worse, rates improving and then getting worse, rates improving and then getting worse. And it seems like we're in the middle of another one of those cycles. We can see here that this was at the beginning of September. The national average was at 6.53. And as we went through the month, they were going down, 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 down. They got all the way down to 6.133%. And this was on September 16th. And this was right after, right around the time that the Fed made their announcement of the Fed rate cut. And then you saw rates going up. So they have actually gone up since the Fed cut rates, which is something I always want my clients to understand, is to be very careful about what you hear in the news, because it's not always an accurate picture of what is actually happening in the market. All right, so now that you got to check out what is going on with the mortgage bond securities market and how interest rates have acted over the course of the past, few months, what does all of this stuff mean to you? It just means that you're going to continue to have more leverage with sellers. A quick example is a couple of the clients that went under contract when rates were at their lowest, close to 6.1, 6.2 range. Some of those contracts came in with no seller credits, right? Which was fascinating to me because it was one of the first contracts I had seen in at least a year-ish time frame, somewhere around there, that the seller was contributing nothing. No title policy, no seller paid closing costs. Why? Because they had 3 or 4 offers on hand. Now, I don't know what the circumstances are, but one can imagine that as rates started trickling down, you started seeing more home buyers enter the arena, more offers to potential sellers or to sellers that were, listing their properties. And then they had leverage. Now they don't have to negotiate with the only one person that's offering on their house. Now they can wait to see who's going to offer them the best deal. And that means not asking for closing costs to be paid for, not asking for a reduction in the sales price. And so those are the real world implications of rates going down, which is why I continue to tell everyone that although it's not the right time for every single person in the world to go out there and buy, if you are on strong financial footing, if you've got strong assets to back you up, and you are in a good, solid place to purchase a home, it is never going to get better than right now. And in fact, the fact that rates trickled up a tiny little bit, I don't think is the end of the world. Do we want them to be back in the 4s and 5s? Of course, I want that. But I also know that for a lot of you, the window of time in which we continue to have leverage as a potential buyer is going to run out the lower that rates go. And so I hope that this is helpful. Just to recap, remember the national average right now is somewhere around 6.3, 6.4-ish range, give or take. There are still other really great programs. The home run program that I've talked to you, I think I priced today for another client was at about 6%, no mortgage insurance, and $1,500 towards closing. That program is still around. So there's still a lot of really great opportunities out there to be had. If you have any questions, please don't hesitate to reach out to us. I hope that this was helpful. And of course, if there's anything I can do to help, please don't hesitate to reach out. Have a great weekend, and I'll talk to y'all soon. Peace.